Welcome to episode number 53 of the National Land Realty Podcast, where we discuss all things land. Our goal here is to inform, educate, and entertain those of you who own land or are interested in the buying and selling of land throughout the United States. My name is Mac Christian, and I am the Chief Marketing Officer here at National Land Realty. I'll be your host for this episode. Interest rates have jumped up again, and they've impacted land sales. This is the latest in a series of interest rate increases that started in March of 2022, and it's resulted in a shock reaction within real estate markets. With interest rates hovering around zero for the past few years, these increases have created a confusing environment for land buyers and sellers. Today, we're talking with Jackson Takach, Chief Economist at the Federal Agricultural Mortage Corporation, or as you probably know it, Farmer Mac. Also, an organization that managed to provide me with a nickname in high school. This is the federal organization that provides the market for agricultural landowners to get loans. This also means that we are talking with one of the most knowledgeable individuals in the United States on the topic of interest rate impact on land. Now sit back and enjoy. I am sitting here with Jackson Takach of Farmer Mac. Jackson, you are the Chief Economist at Farmer Mac, and an organization that I love just because of the name. Jackson. So tell me, Chief Economist there. How did you get to Farmer Mac, and sort of professionally, what's your journey to where you are now?
Well, thanks for having me, Mac. Happy to be here. And it's been a fairly long and winding journey to get to where I am today with a great company, Farmer Mac. I grew up in a small town in Kentucky called Scottsville, Kentucky, and I went to school at a small liberal arts college in Kentucky called Center College. So I was a Kentucky kid, born and raised, grew up doing all sorts of farm handy things as you tend to do in small rural agricultural communities. So, baling hay, tossing hay, cutting tobacco, setting tobacco, you name it. I was doing a little bit of it, and never in a million years when I got my degree in economics did I think I was going to get back into agriculture. I thought I'd seen the last of my agricultural days, but found my way to Washington, D.C. A friend of mine had a spot on a couch. I jumped on it and then found my way to this great company called Farmer Mac, where I joined as a research associate and kind of spun around inside the company doing different jobs and working in credit, working in finance, working in the data science team. So doing a lot of different things around the organization, and really discovered a passion for the agricultural economy, the things that really drive the business at Farmer Mac and at banks and farm lending institutions across the country, and really developed a talent and a skill for talking about that stuff and going around and talking to farmers and bankers about the state of the ag economy, what things are affecting them, how they should think about them, and writing this great publication called The Feed that we put out quarterly on Farmer Mac's website. And here we are today, and I'm talking to you about all things ag economy and interest rates and how that might affect land values.
It's very, very fitting that your exact profession is exactly what we're talking about today. So I find that very, very convenient. So let's jump right in. And I want to take this from a base level of understanding the big news throughout the last year has been interest rate hikes. And the key thing that everybody says is, the Fed just raised the rate again. And it comes about in conversations that, like, even understanding what that means it can get lost really easily because it's in news, but it's not explained. And again, we're talking about the Federal Reserve as a lending institution, basically. And raising interest rates. Just tell us from like a base level, what is the chain that we're talking about here? Why, how the Fed functions? Because I want to take it from a 101 level. This is something where, like, it's a question that I think a lot of people don't want to ask because it's like, I don't know how that works. I don't want to ask because I don't want to get put on the spot. So I'm going to go ahead and do that. Can you explain to me how the Fed works and what this whole hike thing means?
Yeah, sure. It's a kind of a throwaway comment, right? Like, oh, my interest rates went up again, right? Interest rates went up again. But what does it really mean? How does it impact farmers, ranchers, rural Americans? All that kind of stuff is it's complicated, right? Easy thing. It's not like buying a pizza, but the cost of my pizza went up. Like, I know what that means. I bought it, but I'm paying more for a pizza. Well, what do interest rates mean? What do they affect? And how does the Fed's action impact the farmers? I'll take my best stab at it And we can just kind of talk our way through it if it does get a little heady at times. Because somebody's saying, the Federal Reserve is a complicated system. It is not making sneakers, right? It's managing capital across a wide and varied economic system. So it's complicated. So jump in here. If I'm getting too in the weeds on something, or if you find that I'm wandering a little bit, please feel free to jump in.
I'll just go to sleep here on the camera. No.
Right. I always think about interest rates as the price of money, right? So when you think about how much does money cost, I pay for things in money, right? So the money doesn't cost anything because that's what I use to pay for things. But when I think about the price of money, it is the amount of interest that I have to pay to borrow it, or the amount of interest that I'm going to get paid to lend it, right? That becomes how much that money is worth to other people outside of myself. So interest rates are really the price of money. And when you have too much of something, right? Anytime you have too much in supply, this is a common problem in agriculture, right? Sometimes we grow way too much corn. What happens to the price of corn when you've got way too much of it? Well, price goes down. Similarly, when you have too much money circulating in a system, the price of that money goes down, and all of a sudden, what do people want to do? They want to borrow it and spend it. That's what they want to do. When their money is widely available, what do they want to do? They want to borrow it and spend it. And for the last, say, 2 years leading up to 2022, so 2020 and 2021, the Fed was like, we want people to spend money. So they lowered the price of it. They took interest rates and they lowered them and made it easier for people to borrow money and spend money. And they effectively lowered the price of money, right? Took interest rates down using the one big tool that they have to do that. And they made people more interested in spending money. So they were trying to jolt the economy by making it cheap to borrow money, lowered the price of it, lowered the effective interest rate. And then that's what consumers did to support the economy in 2020 and 2021. Now, the downside of cheap money is, well, if you have too much of it circulating around and people are bidding on a fixed amount of goods, assets, what happens to the prices of those assets? They start to rise, right? So we had too much money chasing too few goods. And in 2021 and 22, we started to see this thing called inflation start to rear its head. So the price of goods, the price of stuff that we were all paying for, groceries, houses, you name it, pretty much everything was rising in price because the price of money was so low. Everyone wanted to borrow as much as they could and spend as much as they could. So with too much money chasing too few goods, we saw the prices of goods start to rise. And the Federal Reserve had to say, wait a minute, I need to make money more expensive because right now there's just too much of it and it's chasing too many goods and I've got prices rising. So I'm going to increase the cost of money. And that's going to do two things. Number one, it's going to immediately slow people down from borrowing. They're not going to borrow as much and just put new additions on their houses or buy a new car. They're going to just slow down the amount of money that they're spending. But it's also going to take money out of the system. It's going to say, hey, look, I can now invest it at a better rate. So instead of spending it on a hot dog, I'm now going to put it in the bank and save it for a hot dog in 5 years. Right. So that's the Federal Reserve's reaction to too little money or too much money is to adjust interest rates to try to get the right balance of money circulating in the economy and price levels in that economy. That's really the Fed's balancing act that they have to do.
Gotcha. And the low interest rate that we experience, like a 0% interest rate, right? And which I want to ask you too, as far as knowing the difference between the Fed rate and
right.
the bank rate and mortgage rate, because those are two different things. But the zero interest rate, is that sort of an unprecedented thing historically in terms of federal interest rate?
Yes. So it's very unusual. If you look at the history of Federal Reserve policy, it's about 110 years, right? The Federal Reserve system has been around. They never wanted to get to zero. And really the first time they did was during the financial crisis of 2008, 2009. They took it to zero in order to do as much as they could to stimulate capital flows. Everybody was kind of, really bearing down and hunkering down in 2008 during the financial crisis. And the Fed really wanted to encourage money to flow through the economy. So they really did an unprecedented thing, kind of took it down basically to zero and made money effectively at the banking level, effectively free to borrow as much as you could and move things through the financial sector. They left it at zero for a long time after 2008, started to raise it a little bit, in the years after the financial crisis. But then during the pandemic in 2020, they brought it back down to zero. So we've been at zero a lot in the last 10, almost 15 years.
Right.
And that's not normal. I think a lot of people kind of got used to it. A lot of people maybe who were coming out of college in that timeline or were new in the financial sector in that timing think of zero as like the normal. But if you look at the 50, 60 years before that, 5, 6, 7% was sort of normal. And that's where we are today. We're at 5%. That's sort of the normal range. And we've been at zero for a long time, and people kind of got used to it, I think.
And that's definitely a thing, because the conversation keeps on happening lately. And I read a report of lenders seeing people getting mortgages right now saying, I'm going to do this even though I can't afford it, and then I'm going to refinance when the rate drops back down. And the instantaneous reaction is like, whoa,
yeah,
don't count on that. Like this is the interest rate where it is now is still historically kind of on the low range, because we've seen interest rates as high as 14%. And what's you probably know this, what's the highest it's ever been?
Yeah. So the Fed funds target got up to nearly 20% during the 1980s. Yeah. It was a Fed fighting really rampant inflation after the 1970s, drove interest rates up to, sort of peak levels in order to combat that, and then brought it back down slowly over the next decade.
Right. So so a 5% range is being sort of normal. Like if that's the mindset, I don't think that should be.
Yeah.
to count on it, because nothing can be counted on anyways. So tell me about and this again for anybody listening, what's the difference between, so when people say the Federal Reserve rate is zero, that doesn't mean anything to a lot of people, because they don't actually see. It's not like I went out and bought my house and got a 0% interest rate on my home loan. Or again, a property or something like that. I still had the lens. So talk a little bit about that structure, if you could.
Sure. So the rate that always gets referenced and tossed around and talked about in news stories is that policy rate, the federal funds rate. And that's set by a small committee inside of the Federal Reserve System called the FOMC that 8 times a year kind of gets together, and their whole goal is to make sure that operations of monetary policy are working effectively and really trying to achieve the Fed's goal of price stability as well as full employment. Those are 2 things the Fed's keeping our eye on, right? Price stability, are prices, sort of holding? Are they violently changing? We want to avoid that. We want a stable price environment, and we want to fully employ American workers. So 8 times a year they get together. We just had one in mid-July or late July. And in those meetings, they decide what is the rate at which banks are going to borrow from us, basically. So they're setting the rate at which banks will borrow from the Federal Reserve and each other in order to meet reserve requirements. So think of that as the wholesale rate that a bank can borrow at or lend at, so they can lend to other banks at that rate. That is the bare minimum rate that they need to earn on their assets, because otherwise, if they can't earn that rate, they would just park their money at the Fed, let other banks borrow it, and they would earn, that 5.5% that we're currently sitting at as the target today, as the upper range of the target. So it's the wholesale rate that banks can borrow from each other at inside of the Federal Reserve System. Hard to get a retail or consumer loan that's going to have a lower interest rate, because lenders who participate in that Federal Reserve System could just turn around and borrow and get a better return lending to other banks. So that becomes like the lowest rate that you're going to see, short-term rate that you're going to see in the economics engine. And then from there, you've got layers on top of that the bank needs to earn return on their capital. There are spread targets, there are credit targets, there are all sorts of things that go on top of that. And that's why you see retail loans like a mortgage being something like the base rate plus 2.5%, or a farm loan. If you're looking at production loans, might be 200, the base Fed funds rate plus 200 to 300 basis points, or 2 or 3%. So you're never going to see, if you do see it, boy, you must be a really good credit if you can get that Fed funds rate as your loan rate. But that's the rate your bank's going to get. So they're probably going to add something on top of that to meet their capital requirements and their returns to shareholders. And the retail credits go at something higher than that Fed funds rate.
Yeah,
that's the only policy rate out there. The Fed funds rate is that policy rate. All the other rates that you see are all market driven. So it's just people borrowing and lending at different rates that drive those rates around. It's that policy Fed funds rate is the one that's set by the Fed.
Yeah, and I think that's the structure that to speak to that's really valuable for people to get their heads around it is banks lend people money. And in order to lend people money, you got to get that from somewhere. You have to have the money, the reserve on hand to cover you. And so they get that from the Federal Reserve. And so if the Federal Reserve rate is 0, that goes to the bank, and then that from the bank to the consumer. But then the banks, every business is in business to make money. So
That's right.
They make money off the money that they give you, but they're able to borrow that money at 0. So that gives you a lower rate overall. And so that structure that like you get your home loan at 6% or whatever, that means the bank is making 6%. And if that bank, like you said, there's banks that borrow from other banks too. And so each one has a market. It's imagine it like retail goods. If you buy a hat online, it probably costs $10 to make that hat. And then, $2 to embroider it. And then the company that sells it to you bought it for maybe $15. And then they're going to sell it to you for 28 because they need to make their profit. Same system, but just with money, right?
That's a great way to put it. There is a series of transactions costs that it takes to get all the way from sort of the core financial system all the way to you as a borrower. And there are going to be costs along that way that get incurred and that drive up the cost of money to you, just the same way as any supply chain is going to have costs along that supply chain. So does the cost of money.
Right. So I want to ask you an opinion question now.
All right.
Do you think that, so what, we saw COVID hit and, lockdown, there was a lot of paranoia about the economy. Everyone started reacting at the front end of this, like, oh my gosh, the world's ending. Economies are collapsing, which looking at it, in that no one's ever, we don't even know what that is. We don't even know what that experience is. So overreaction is really the only reaction at that point, because you just don't know what's going to happen. So they marked everything to 0. Did they keep it there for too long?
That's a tough question, right? So, I mean, there was a lot to balance in that time. You go back into that, the soup of that, and you had homeowners who weren't sure if they were going to be able to make their payments. You had renters, you had, securities backed by, billions and billions of mortgages. So there were a lot of things that the Federal Reserve had to take into account, not to mention that there were massive layoffs and the whole, the structural integrity of the economy seemed to collapse there for about 6 months. And I think the goal became, hey, we want to stabilize prices and we want to maximize employment. And that might take time to do that, right? I think that was sort of the commitment from the Fed at that time. If you go back and read statements from Chair Powell during that time, well, I thought he was a great voice of stability and reason, along with, individuals out of the Treasury and the White House. I think everybody really did a good job sort of getting together and be like, hey, we're going to stabilize things. Like, our goal here is stability. Whether or not that they could have made changes sooner or later, I think, that's certainly easy to Monday morning quarterback that and look back and say, hey, I think the right time to start was probably, 6 months before they did. And I certainly was in that camp of, hey, I think I can look back and say when we should have started raising interest or changing the price of money. However, it was a difficult position to be in. And I think they did a remarkable job of managing the uncertainty that they did in the time that they did. And you get into the 2021, early 22, and you start to see that inflation, the price of everything start to spiral. I think that was really, there were a lot of voices out there saying, hey, maybe prices are rising too fast. And I think the Fed got on top of it, in a timely manner. They did what they needed to do and started raising interest rates. Would I Monday morning quarterback and say, should they have done it 6 months earlier? They could have done it 6 months earlier, and I think it would have been more effective. However, they did it when they did it. And I think the effect was important. We started to see inflation come back down. Inflation has started to come back to a more typical level. So, hey, raising the interest rates when they did, maybe it was a little late, but it had the effect of slowing the economy, cooling the economy off. And that's ultimately what they were trying to do.
Yeah, I was going to say, it's because the situation that we were in, with a pandemic that no one's ever seen before. And it's like, imagine it, like if you had never seen fire before, you might try to put it out with gasoline. You never know. Like if it's an unknown and it's on your doorstep and you have no idea how to react to it, there's not really a wrong reaction at the time, but like you use the tools that you have to deal with the job, and they did that and drove the economy. Well, then nobody could have possibly predicted probably. And that's, this is kind of a statement / question for you.
Yeah.
Is nobody could have predicted an environment where people had cash on hand and just wanted to throw it around. Like people started buying like crazy during this time because nobody was driving for work. A lot of the overhead in people's lives was not there. And the people that didn't get laid off in the service economy had money to spend, and things went wild. And then the infrastructure for all the companies had to shut down their supply chain because they thought that everything was going to collapse. And then spending goes crazy. And it's like, okay, I shut my hat distribution down because I thought my business was going to fold. And now everybody wants a hat. And so now I've got to mark up to speed up the delivery and get it there. And so the political conversation is crazy because we're going through an election cycle and everybody's trying to blame everybody for everyone's problems. But it just comes down to a supply and demand problem that we're going through right now. And it's done it for everything. And now the Federal Reserve has started hiking rates. And now that's impacting with an economy that's been on fire. It looks like it's impacting everything negatively. And that's where I want to kind of tie this back into farming and land markets. Interest rates are going up right now. And that's something they had to do to keep broccoli from costing $50. It's like because the demand's so high for product and the delivery costs more now. Now we have like gasoline prices and stuff like that. Like gasoline's way up there and supply chains are finally getting back together and prices are coming down. But now we have the interest rate rises, and that's affecting borrowing. So what is that? How is that impacting the land market, the borrowing market for land? And then, we can talk about inputs there as well. But I mean, I want to, obviously we work with land, but I don't want to isolate just one thing because the economy is much more nuanced. But it's good. Talk about that a little bit if you could.
Sure. So we'll start with land because that's where my perspective at Farmer Mac, we're the secondary market for ag real estate. So this is something that's near and dear to my function here at Farmer Mac. So we'll start there. But I agree with you. I think we should talk a little bit about the production costs as well. Yeah. Because that's probably more immediate impact. In the land markets, a lot of real estate debt. So a lot of people who are either buying land or refinancing land over the last 4 or 5 years were able to do so at very attractive levels. So if you bought a farm and you used leverage to do it, or you had some debt and you were able to refinance it down, you're looking at something like a 3, 4, or 5% mortgage rate. Very low levels. And a lot of the deals that we saw at Farmer Mac coming through our channels, we're looking at 10, 15, or 30-year fixed rate financing. So that means their interest rates are not going to change for 10, 15, or even 30 years. Those folks are impacted absolutely zero by the rise in interest rates, right? Because they fix their interest rates on that property at those levels for the duration of the loan. And that's something that's kind of unique. If you go back to the 1980s, you hear a lot of people talk about the farm financial crisis of the 1980s. And are we seeing parallels today? And my answer to them is always, irrevocably no, we are not, because more farmers did more borrowing at longer terms for lower levels and have sort of fixed those costs. They're not going to see those costs rise at the same level that they did in, say, 1978 to 1980. So I think that's one, really important nuanced point here today, is that a lot of people took interest rate risk off the table in 2020 and 2021. And those folks are not worried at all about the current level of interest rates. They're kind of riding it out, and their land costs are fixed for the life of those loans as long as they keep paying as agreed.
So really quick, just to because that is brought up a lot, is the 1979 sort of like when farmers went belly up, right?
Yep.
And the similarity that everybody's seeing is the price of land shoot through the ceiling for food producing lands, and so everyone's tying it in. So if you could explain sort of like what drove that during that time period, and you just spoke to the fixed rate kind of making things stable.
Unwind.
But sort of what drove it back then to kind of like, oh, okay, like to highlight that.
Yeah. So in the 1970s, you go back to and study sort of what was driving that run up in land values. Not dissimilar to what we saw in the last couple of years. You saw grain prices run up quite a bit. You saw huge gains in efficiency on the farm. And then we had a grain deal with the USSR, Soviet Union at the time, all of which said, hey, look, we have a huge demand for wheat exports. Export markets were flying. So plant fence row to fence row, right? The famous Earl Butz, statement that made farmers everywhere famous for being incredibly efficient producers of food products. So people borrowed a lot of money. Interest rates were relatively low back then. So they borrowed a lot of money, bought as much land as they could, and started to build up the asset values and the prices of land through 1970s. In the 1980s, there was like a strange confluence of stuff that unwound. Basically, all those good things went negative. So we had the grain embargo, right? In the 1980s, cut the legs out of the demand. All that grain that we put into production in the 1970s, all of a sudden was creating supply that we couldn't deal with. What happens when you have too much supply? Price goes down. So the price went down and you had high interest rates. So interest rates started to move up because of inflation. So you had this like weird combination of stuff that took revenue down, took supply too high, and interest costs skyrocketed. The other thing is a lot of that land was leveraged with variable rate loans. So when interest rates went up, they didn't have that buffer period where they could, sort of just ride it out. A lot of those interest rates immediately or within 1 or 2 years switched to market rates so that they had higher interest costs on that land almost immediately. So it's a bad recipe, right? And a lot of people had to sell land or land was foreclosed upon, and a lot of really horrible stories about families losing farms and properties. And we could have a whole session just on that, 3-year period, 5-year period. Today, we did see the run up in revenues really drive interest in the asset class. We saw, some of those similarities in land value appreciation. But what's so interesting today, beyond, I think, interest costs being a little bit fixed and the product choices being a little bit more long-term, if you look at the real gains in land values, like the amount of appreciation in land value minus inflation, it's much more modest today than it was in the 1970s. 1970s, it was real gains of like 10 or 12%. The last couple of years, even though land values have risen a lot, if you consider the price of everything rose a lot, they didn't rise that much more than all the other stuff. So if land values went up 30% in 2 years, well, the cost of everything went up 20% in 2 years. So you're looking at about 5% real appreciation per year. It doesn't sound quite as bad as like 30% over 2 years. Well, so did the cost of used cars, right? They went up 30% over 2 years. So land values relative to everything else went up at what I would consider to be a fairly reasonable rate over the last 2 years.
Yeah, and then the big one there too is the fact that everything was linked through, or a lot, not everything, but was linked to variable rate borrowing. Like, so if I bought my farm at a 3% interest rate, but then overall interest goes to 10%, well, then my rate goes to like 10%. And all of a sudden, I can't even afford to run my operation. I'm done. And now with a lot of people locked in, you're going to be paying the same rate for years and years. And it's like, as you look at the crises that have happened in the last, 30 years, that variable rate borrowing has sunk us like 10 times now. Like, it's crazy. But with where we're at now, and like, if you wanted to talk to, I don't want to jump ahead because you were talking about jumping into inputs a little bit too. Let's do that because it matters that while the price of land has gone up, the price of food has gone up, there's also the input prices that go into that. If you could jump into that a little bit.
Sure. Well, so I think more directly, so we say land value, the land real estate expense, interest expense isn't going to change that much. What will change almost immediately is the cost of that production credit. So these are the loans that, producers come back every year and renew their operating line. They use it to buy inputs. They put them in the ground and then they sell the crop and pay the bank back, right? This is the sort of annual renewal line of credit or intermediate loans that may be used to buy equipment and those kind of things like that. Those are almost always short-term fixed or variable rate. Right. So that's the highest exposure that the farm sector has to interest rate risk is going to be on that production credit. And this will be the first year we've really seen it. In 2022, yes, the Fed was raising rates, and so banks had to slowly increase their retail credit rates, the rates that farmers would pay on their operating debt. But it wasn't nearly as much as what we probably saw in March or April of 23. So when farmers were coming back to renew the credits for the growing cycle in 23, now they're facing 200 basis points of increase. So that's really going to be the first time. 23 is really the first time we're going to see a sizable increase in production ag credit interest expense. It's not crazy. I mean, if you look at the levels, the overall levels, what USDA says farmers have in production credit, it's about a half of what they have in real estate. So really what farmers have done is push more debt onto the land and keep about the same levels of debt that they have in the production credit, which is pretty good if you think about interest rate risk management and how they're going to manage their interest rate risk. I feel pretty good about it. But this is going to be the first year that we see a lot more impact in production credit. And that's going to drive up the cost of producing food. And 23 is the year it's going to happen. Really skated by in 21 and 22. Maybe there were some other costs that were driving there, transportation, labor. Of course, you had, fertilizer was a big one last year.
Yeah, fertilizer. This
year, the big one we're probably going to be talking about is either the cost of water, if you're maybe, hydrating stuff, or you're going to be talking more about the cost of interest.
Gotcha. And then with sort of how things have been structured over the last few years, and like we saw record gains across the country, like with Kansas, Nebraska, Indiana, most of the Midwest states experienced the highest land values they've ever seen. Per acre. We saw land moving to like $24,000 per acre in terms of land values. Those, a lot of them are protected from interest rate risk. What I wanted to ask you too is there, now that sort of the interest rates have sort of been stabilized, is there inflationary risk in that now that the price of goods has gone way up just due to demand, and that Ukraine's impacting that as well? If the price drops, if the inflation, so are they now opened up to more inflationary risk or I guess deflationary risk in that respect? Is that sort of increasing market wide?
Well, I think that's an important distinction to make. Is it deflation or is it a reduction in inflation, right? So those are kind of two.
Okay, no, let's go there. Yeah,
they can be two different things, right? So you can still see prices continue to go up at a slower pace. That's what the Fed's hoping for. They don't want to see deflation. They want to see prices go up, but at 2% per year instead of 12, right? Where the ag economy tends to go is we like inflation. Inflation's generally good for farming. It's generally good for farm real estate. And it gives, the grocery stores a chance to raise prices, which then gets passed through the supply chain back to the farmer. So in inflationary periods, the agricultural economy tends to do a little bit better than times when inflation is low or deflationary or negative. So I think you're exactly right, which we don't want to see in any industry. And I think the government tries to avoid this, and every government and central bank tries to avoid deflation, because that's when you get into a lot of downward spirals. So if prices start to go negative, everyone says, well, I'm just going to wait and I'm going to buy my thing. I'm going to buy my hot dog in 2 years instead of now, because I know that in 2 years, the hot dog's going to be that much cheaper, and they hold on to their money. And then you have consumer spending go down and all this bad stuff can happen. So deflation is really, I think, what everyone in the policy sphere is trying to fight against. They do not want to see deflation. In the food sector, you typically don't see deflation. Typically, once consumers hit a level of what they're willing to pay at the grocery store, you may see very low inflation. You may see 0 to 1% change in the grocery store, or you may see temporarily like meat prices go on sale. So beef can be negative for a short period of time. But what tends to happen is you get to 0 and not negative. So we don't see a lot of deflation, and I'm hopeful that this case is no different. We won't see a lot of deflation this time around. For land values, really, I think as long as we can maintain a positive rate of movement in the food economy, the farm economy, I don't expect negative impacts on land values. However, it's all about, can it generate a sustainable return? Can agriculture continue to generate a sustainable return in the face of higher interest rates? That's what it's going to come down to. It's all about real returns in the face of higher interest rates.
So, and what you just spoke to is sort of the mechanism behind what a lot of the conversations that have happened lately around land is when people talk about land values and predicted, the predictions at the beginning of the year were that we're not moving towards a decline in land values. What we're probably looking at is a plateau. Things are going to level off. And what you just spoke to is the mechanism behind that, because prices of food, it's not like wheat is, I'm going to make up prices right now, so please don't judge me on the prices. Like wheat is going to be like $5 a pound, and it's not going to drop to one all of a sudden, because one, economically, that's just how it happens. Once people are willing to pay a certain price, you don't see companies marking down the price of their product because unless they just stop buying it altogether.
Right.
And so like you won't see that. And people are not going to stop eating anytime soon, to my knowledge, unless they come up with a way to like convert air into food or something. Right. Like that's not going to happen. So we're looking at a plateau stage in terms of land values, especially cropland values, right? Because if it makes food, people are going to utilize it. The price of inputs is going to change. And, we don't know what's going to happen. Like we saw with natural gas, right? That influenced the price of fertilizer through last year pretty heavily. So as we move forward, there's this interesting dynamic where you have landowners who have financed at historically low prices. You have lands that is going to market, but now to get a loan in it, it's remarkably higher prices, or people who want to sell off and buy at new locations. There's kind of there's a lot of landowners now that are sort of upside down in terms of market value, where you have, I've got 1,000 acres financed at like 3.5%, and I want to sell that and buy in another state or whatever it is, but I've got to buy there at like 6.5%. But now, so I can't get the same amount of land for the same price, I've got to downgrade. Like I'm sort of upside down there. So is it a matter of people just need to get more efficient if they want to if they want to buy, sell, or and I guess the big question is a 1031 exchange now the most valuable thing you could probably do?
Well, so I'll say there's a lot of dynamics. What you're talking about is sort of similar to what we see in the housing markets at this time too, where there's just no supply because everyone's kind of hunkered down, and either they're totally comfortable where they are, like where I am. I don't want to ever sell. I got a low interest rate mortgage. Like I got enough space. Like I'm never going to sell my house. But the people who want to live in my neighborhood are desperately hoping that I'll sell my house. And I think in agriculture, you have some similarities there where families, unless they need to sell, are probably going to try not to. And so that's going to create this artificial drop in the supply of land, which then when something does come up for sale, probably continues to see a boost from just the lack of other properties available. So maybe they're not selling for the 25,000, the eye-popping, headline-grabbing numbers that you used to see, but they're selling for average or slightly above average of what might be expected for that type of property at this time. So we're seeing, I think, a lack of supply come to market because of lower interest or because of higher interest rates, and people who own land are kind of comfortable with where they're at. That can change with a couple of things, right? It could be transitions, family transitions, right? Can open up things. So a long-term landowner operator of a farm passes away. All of a sudden the kids have some different ideas of what to do with that property, right? So that can unlock land and increase the supply. Or a lower farm economy. So maybe take a divot out of the farm economy in the next couple of years. Perhaps that's something that unlocks people's need to put more land into market. Or there's like tax. There's things that can be done from a tax base, like the 1031 exchange, and then that can unlock value and maybe cause some transactions to loosen up. But until something happens, it's almost like the supply is going to stay artificially low. And just like in the housing market, you've got a lack of land coming up for sale, and that's keeping some pressure on land values. If that changes, that's going to be the catalyst that could take land values and make them more volatile or put some downward pressure on them.
So you spoke to people kind of sitting on land right now and watching the market and it's a justified fear reaction, I think is sort of where it is. Do you think that the fear reaction that we are seeing is I want to say logical, but that makes it sound like it could be illogical as the opposite, and that's not the case.
Right.
Is it justified that there is something to worry about, or should people be sitting on it? And again, that's more. This is an opinion thing. I don't want to put you in the position of giving official sort of insight on it unnecessarily, but sitting on the sideline, is that a wise move right now for people that are holding land, or is it still a decent time to make a move?
Well, I think every single operation, every single landholder, every single investor in land probably has a different perspective on that, right? So everybody's going to have different. I'm 100% pro economic situational decision making. So it's very difficult to give sort of broad strokes, opinion of is it a good idea or a bad idea? Because it's going to be different depending on the operation that you talk to, whether or not they should, if they've got good access to capital at low cost, maybe they don't need to liquidate land. But some may say, hey, look, I need to free up some capital to make some moves in other places, other states, other counties. And they may see an attractive, hey, I can sell now and then I can park it in 1-year treasuries at very attractive rates, right? So it's going to be highly situational, highly dependent on the economics and the balance sheets and the income statements of the operation itself. But I think that now is the time as everybody starts to recalculate, now's the time to get strategic. And that's one piece of advice I always give out to bankers and farmers, no matter who I'm talking to. In times of change, now is the time that you need to give yourself the most optionality and get prepared to make strategic decisions, because this is the times of change when you're pivoting from a good economy to a bad economy, or a bad economy to a good economy. That's the time that having a little bit of working capital, having optionality gives you the edge over your competitors and the people in the communities whom you're looking at to buy land from or sell land to. So I'm all for situational economics and giving yourself as much optionality as you can. And if that means sitting out for a little bit, that's what that means. If it means making some transactions, that could mean that as well.
Man, that was a dangerous question to ask. You just fielded that beautifully. That was I'm impressed, because it is. If you paint with broad strokes, you're going to miss something. So what you just spoke to, I think, is of value to anybody listening. The land industry in general, just because of how loans work in agriculture, there's ag lending, which works a little differently. It's easier to acquire than and a lot of what we work with is recreational land. Tends to be almost completely cash driven because it's non-developed land, it's non-income producing land. But in general, is the land industry a little more insulated from interest rate risk because of the amount of cash that's involved? Because you're not, it's not like residential where you can put down 5% and get a house, right? It doesn't run like that. So is there some insulation there just due to how it functions?
Yeah, for sure. I think there's a lot less cash flow risk because of the lower loan to value advance rates that this industry lends against. So if you look at the average loan in the secondary market, it's trading at something like 55% or 60% is the average LTV. Very different than what you would see in the secondary for residential, which is more like 90% or 95% loan to value. So I do think that creates a lot less cash flow risk. I don't think about it as interest rate. I think that is hey, you just need less money to service the asset itself because you've borrowed a lot less. So even if interest rates move up and down, you're not going to be super stressed out with payments on the loan. And there's a lot of equity for you to cash in on should there be some cash flow constraints down the line. So for sure, I think that takes some of the pressure off. I also think, hey, having more people think 10, 15, 25, 30-year fixed rate terms, I think that takes a lot of the pressure off. Residential's kind of moved that direction over the last 30 years with a little bit of a blip in 2005, 6, and 7 when everybody went adjustable on their second and third and fourth homes. But other than that, I think in the ag space, people tend to think a little bit longer term. And then that's helped, I think, take a lot of interest rate risk off the table as well.
Got you. And so different market dynamics, people looking to enter the agricultural market that are not currently in. So that's people that are already in the market. They already have typically the cash on hand, at least as leverage to be able to put into something else, or understanding or having the reserves there to be able to expand or, to get the cash on hand and to purchase new land. But people that are new to market, what is sort of their avenue to do so?
Yeah, I think they're in the toughest spot here. So anybody who's got some capital, wants to put it to work. I mean, the agriculture is a super capital intensive business. The land's expensive, the equipment's expensive, the inputs are expensive, right? So it's really a difficult thing to start up at scale without. So people who have capital, I think, will find it relatively easy to put it to work. As long as some of the supply demand stuff that I talked about in terms of land markets frees up a little bit. Trying to get cow. So if you're a new farmer and you want to go to a bank and say, I need a loan to buy some land, that's going to be the toughest conversation because land is more expensive. The cost of borrowing, the cost of capital is more expensive. And a lot of banks, have to ask a lot of questions. There's a lot of, transactions costs with starting up that relationship, but it's very doable. I think lenders love working with new beginning borrowers, bringing people into the agricultural ecosystem and family. So I think there's a lot of bankers out there who are looking for new relationships and younger, energy in the agricultural space. There's also a lot of great programs with the USDA. So for new beginning, small farming operations, there are grant programs to help with down payments. There are guarantee programs to help with access to credit. So if you were maybe trying to get something like a higher leverage loan, like maybe not a 99% leverage loan like you could do in the resi world, but maybe something higher than 60% that you tend to see in the more retail ag credit space. The USDA has programs to help get that type of credit out into the marketplace. And they really do a good job, I think, of managing interest rates. So they're not charging 12 or 14% on that higher leverage loan. It's something more in market that farmers can afford on the revenues from the farm. So I say, hey, strike up a conversation with the bankers, go to the banks to have those conversations, build those relationships, but also look at the USDA programs that are designed to bring people into agriculture and really help build that community and ecosystem.
So last two questions. And like I said, I want to respect your time. I know you got a day to get onto and everything, but I wanted to ask you, one, put on the crystal ball and sort of give what you think is coming up in the next, let's say 6 months, because
Sure.
a year is impossible. But in the next 6 months, what we're looking at market wise and specifically towards land markets and sort of like how that's functioning. And then what I want to do is just give you an opportunity to throw a plug for Farmer Mac and talk about Farmer Mac's role within that ecosystem and sort of what they're evolving into, or what Farmer Mac is looking to do to work with people as the next few months come along in the market.
Yeah, you bet. We'll start with the crystal ball. I'll get my little the mentalism hat, and try to come up with a couple of predictions without getting too far over my skis here. Look, you read all the stuff from the Federal Reserve. They just did another quarter point raise in the last week or 2 weeks, depending on when we go to air. So you read all the information about there. It seems like they're sort of shifting from active fight of inflation to more of a passive monitoring fight on inflation. So what I read when I look at some of those statements is, hey, we're not done, but we're also not trying to continue to raise we're not raising interest rates just to raise interest rates, right? We think that we're threading that needle appropriately and will be data driven. So as I look at what could happen in the labor markets, I'm watching those to say, hey, are those going to soften anymore? Is the access to credit going to soften anymore? What's going to be the thing that could cause that recessionary state that might trigger a release from the Fed to start lowering those the federal funds rate? And that's why I'm just going to be completely data dependent, right? So I think the labor markets are holding up pretty well. I look at the housing markets; they're holding up pretty well. And I think we're in this sort of nice, steady state environment where a lot of the economic data says, hey, things aren't bad. They're not as good as they were in 2021, but they're not bad. And then if that's the case, then I think the Fed kind of holds steady at the current rate. So 550. So if data dependent, you look at maybe 550 is their terminal rate. Now, if inflation picks up, I think they continue to rise. If inflation goes down, maybe they hold and then eventually release. But I think over the next 6 months, I think steady as she goes is probably Chair Powell's daily affirmation, right? Let's just keep it steady as she goes. In terms of land markets, I do think, we'll start to see some pickup seasonally. So you get into third, fourth quarter, that's when you see a lot of activity as the harvest completes and people start to look at balance sheets for next year. You do see activity pick up, and I expect it to pick up A, seasonally, but B, I think people are starting to get used to the interest rates. At first, it was a shock. I don't want to do anything. My God, 6, 7, 8%. This is totally new to me, and I don't want to be in this position. But the more people I talk to, they're still sticker shocked, but they're also making those decisions that they're thinking more long-term about, strategically about asset acquisition, liquidation, those kind of, they're making those decisions more strategically and less on cash flows from year to year. So I think that will put some more land on the market, as well as drive some demand for land in the third and fourth quarter. So I expect land markets will either return to that seasonal level, or maybe at least just pick up a little bit from where they are today, as people realize, hey, maybe interest rates are going to hold at this level for a little bit. They're not going to go up a lot more, but they're also not going to go down a lot more. And certainty creates the greatest foundation for business planning, and I think we're going to start to see that come to fruition this year.
Awesome. And again, tell me a little bit about Farmer Mac and sort of the role that they're playing in this economy and in the environment that we're in. And, you giving your time is useless unless you get to plug yourself, right? So, tell me a little bit about that and sort of like how Farmer Mac is working with people moving forward.
Yeah. Well, I'm happy to, and thank you for giving me my the 30-second commercial for Farmer Mac. Look, I've worked at Farmer Mac for almost 20 years. It's a really exciting, cool place to work. It's a 35-year-old institution. It's a government-sponsored enterprise, meaning that 35 years ago, Congress said we need a company that can come in and provide support to ag lending and rural state transactions specifically. And we've been around ever since. We came about in the 1980s farm crisis. I mentioned that once. We talked about it twice. And coming out of the farm crisis, there was a lot of questions about, hey, what could be done to help create more liquidity for ag real estate loans, to give banks a place to sell them, to give other lending institutions a place to make and sell loans. And a lot of lenders at the time said it would be great if we had something like the residential markets have. We don't have any place. I make a loan, I got to sit it on my books for 20 years, and I'm a bank. What am I supposed to do? I have to make a short-term loan because that's how banks manage assets, right? It's got asset liability management. But if you make a secondary market, all of a sudden, maybe I can sell that loan. I can offer a 30-year fix, or I can offer more beneficial terms that help farmers, ranchers, rural Americans manage their interest rate risk better. So that's how Farmer Mac was born, kind of coming out of that 1980s farm financial crisis. And ever since, we've evolved in lots of ways to serve rural America. So we do rural infrastructure lending, so helping cooperatives achieve lower costs of delivering, telecommunications and electricity for the hundreds of co-ops out there that provide power and connectivity to rural Americans. We have a USDA guaranteed line of business. So we're helping the USDA expand their access to credit, making sure banks all across the country can participate in those USDA guaranteed programs. We've worked with over 1,500 different lenders to provide access to capital and credit and lower the costs at those institutions. And they pass those right along to farmers and ranchers in the form of lower loan interest rates and more favorable terms and conditions than maybe they could offer themselves. So we've been growing the business ever since, about a $26 billion operation today. So we're very active in lots of different markets and looking at all the ways that we can to make conditions better, easier, faster, more efficient for agriculture, for farm lending, and for the food supply chain and rural infrastructure. And that's the elevator pitch in a couple minutes or less.
And you spoke to the USDA options that are available for, say, somebody new to market. And sort of y'all are the ones that are helping drive that, right, from behind the scenes.
Yeah, it's one of our many programs, right, is to buy the guaranteed portion. So if the USDA makes a guarantee that there's a place for a bank to sell that guaranteed portion and do it at an efficient and low cost transaction, right? So we're helping to create liquidity in that product for the USDA. And USDA has other on balance, so they keep the loans themselves. They have several loans that they keep themselves, and we've seen people piggyback those loans together. So there's lots of really interesting and creative ways that can be we work with lenders to help them structure the best deal possible for farmers and ranchers.
And as far as functionally in the marketplace, Farmer Mac, do they work? You spoke about the work that you do with institutions, USDA, lending to banks and things like that. Is there pieces of that work direct to consumer, or is it primarily behind the scenes that you function?
Yeah, we're all behind the scenes. So our primary customer, B2B, right? So we work with the lending institutions, and then they're the front ends that go out and work retail with farmers and ranchers and consumers directly. So we have there's no Farmer Mac retail office that you could walk into and say, hey, I'd like to get a loan from Farmer Mac. It's all working with our great network of lenders all across the country, where we have lenders in 50 states, plus some territories, I believe, who are active in their communities, making loans, and then using our programs to enhance and create additional value for the farmers and ranchers in their communities.
Yeah, and I think that's important to know, because if people, I'm sure people see Farmer Mac on things, and it's like, well, what is it, and how does unless they're knowledgeable in that area, like you're kind of working in the shadows. You're Batman, right? It's not something that you're going to interact with directly, but you receive the benefit of the work that you do.
Yeah, that's right. That's right. Our goal is not to intervene in the great relationships that are built between the lenders and the communities that they serve. Our role is to provide great liquidity, reliable product, and we're looking for ways to improve access to capital using technology, financial technology, but also just, the transactional cost that it takes to get a mortgage. How can we do that better, which is going to reduce the cost to the farmer and speed up the access to capital? So those are the kind of things we think about. It's more the ecosystem. How can we deliver the best possible experience to the lender? And then that lender can pass on all those benefits to the farmers.
Excellent. Well, hey, Jackson, again, I want to respect your time. I'm taking you a few minutes over here, and I'm sure you have something to move on to. So I just thank you for taking the time to have this discussion. I think there's a lot of value in here for anybody listening to sort of have a grasp on the market. Any sort of like last piece you want to throw out here before you jump off?
No. Hey, I appreciate the time, and always willing to talk interest rates, land values, ag economy. I mean, that's you. There's no taking me over a few minutes. I will just keep going as long as you are recording. I will keep going. So thank you for your time.
Yeah, that's a dangerous thing to say to me. I'll be on the phone, man. I appreciate it. This concludes episode number 53 for the National Land Realty Podcast, discussing Federal Reserve interest rate hikes and their impact on land with Jackson Takach, Chief Economist at Farmer Mac. You can learn more about land ownership and the buying and selling of land at nationalland.com.